Now let's compare our first two. That's our growth investments, shares and property. So I'll declare my bias up front. I love both, I own both, and we encourage our clients to own both. So let's compare their basic features without forgetting what their biggest benefit is, and that is that they grow in value. And we'll have a look at how much in just a moment. So liquidity is really the ability to sell your investment into cash. With shares, generally can be easily sold, and shares on the share market can be in our bank account within 3 to 4 days. Managed funds, a little bit longer, 1 to 2 weeks. And shares are easy to divisible, so we can sell parts of our shares when we need to. Property takes a little bit more time, from weeks to months, and is not divisible, so we can't just sell a room in our house and keep the rest of the property. Risk management, all investments have some form of risk, absolutely everything, even government bonds. So just like all activities in life have risks, like crossing the road or driving to work in the mornings, but just because something has risk, it doesn't mean that we don't do it. It just means that we need to do a few things. So we've got to understand what those risks are. We've got to avoid the risks that are simple to avoid. We've got to manage any of the other risks. With shares in property, property, it's harder to diversify specific risk, generally because properties are higher and can be purchased higher in value with more lending. Easy to diversify specific risk with shares. We can buy managed funds that have, multiple shares within them. Both carry on market risk because we're invested in a market, and the volatility of the price differs for both of these assets.